I just want to make analysis. I just want to analyze the charts starting from the monthly chart to the weekly and daily. So this is how to approach the market. I'll show you the reasons and why I decided to take this and what affects this and what you're supposed to do while you're starting analyzing. So mostly this is what I do on the weekends before the the market opens. So the forex market, it's from Monday to Friday, and Saturday and Sunday the market is closed. So over the weekend there are more news that is likely to happen mostly, so you need to at least be ready for what's happening. But the market, the news that are happening, they're not happening to make the market be wrong. No, the market will just follow I'll say some algorithm, how it's supposed to be. It's just that you can't predict where it goes, but you can predict by you can just, like, maybe you look for probability, what it must go or what it must not go. And the reasons it makes, the more probability reasons, like you have 5 reasons why it will be bullish and 3 reasons why it will be bearish. So the more probability reasons, they make it higher chances for it to go. So that you say the win rate, normally it becomes maybe 70 for the person who's more on forex, like it's like 80%, or so let's say 75%. You can't be right all the time, you can be right 100%, but what matters is how much you lose when you are in a loss trade, and how much you win when you're in a win trade. So this brings it to be also, apart from the technical analysis, you also look about the risk management. So sometimes it must be maybe 1:3, 1:2. I'll talk about this when I get time in this video. So this video, I just want to take maybe 20 to 30 minutes of your time to make analysis on this. So as you can see, this is the monthly chart of EURUSD. As you can see, EURUSD is one of my best currency of all time. So I just want to teach you something about let me just teach you something. This is ICT. So I want to teach you something about ICT. So before we go to the, let's say we mark which year are this. Let's say we mark from this is 1 month, a minute. Yeah, so this is 1 month chart. I just wanted to mark a region so you can analyze from the region, right? So this is it. Just want to like a big region, so I'll say this area. To this area. So this is the area I want to analyze it. Let me just mark it as what do you see in this area? Like most of the people who maybe have an idea about trade, what you see in this area, it's a chart worth like from 2018, from February 2018 to December 2024. This is 6 years. What happened in 6 years? So each and every candle, it's worth 1 month. For it to go and close, it's 1 month. And I just want to give you something. So in this, before you do anything, before you look for PDRs, I know you know about fair value gap, and if you don't know, I'll also teach you about fair value gap. And you also order blocks. So if you don't know about order blocks, I'll also teach you order blocks. So this is my what I normally do. This is my strategy. So before you start anything, you need to mark the high and the low. High and the low. And how will you know the high and the low? So there's three factors you know you want to catch about the high and the low. First factor, it's a sweep of buy side liquidity. Sweep of buy side liquidity. Then number two is sweep of sell side liquidity. Sweep of buy side liquidity and sell side liquidity. So you mark the zones. So as you can see here, we had a sweep of liquidity at this area. Yeah, so this was a sweep of buy side liquidity that will mark it as the high. Let's just keep it narrow. Let's use this one. We use the okay. So this is the sweep, the high of this region, and also the low, because we swept this liquidity. So this will be the low. Let me just keep this as a color blue. So this is the high and this is the low. So in between this, let me keep it large. This is what we are looking in between these. As you can see, we can just mark. We start marking with the fib retracement. In the last video, I showed you how to set this region. So let me just correct on this region, that is 75. 25, 0, 25, 5, 75, then 1. I cancel this. So this is what I want you to have an idea of, and we save it, right? Let's keep it which color? I think the black. Let me try blue one. I think the blue one is best. So this is the region, the high and the low. We drag it to the, so we started marking this. We'll mark these zones. As we mark, I'll use these areas. 1, make it this as black. 1, then 2, 3, 4, 5, So this is the region, so you just close at this point and close this point. So as you can see in here in between, so this is the 50 range. I wish I could just keep the simple one and remove all of this. So let's just keep it again. Okay, so these are the regions. Let's keep it to be on the right side. Labels are being drawn on the right side. And font size, let's keep it at 11. Got some flow, I'm sorry. So these are the regions. So these are the I'll say I'll call it magical lines, levels, but normally these are the main levels, like the grade levels. Other now, we'll call other name grade levels or DRT levels. These are the levels that once these are the level where price meets, like price reverses, not because they are more important level, but because there are PDRs, the arrays that are formed in between those levels. As we go deeper to the analysis, we'll find out that the price is aligned. If the price aligns, this level aligns with the PDRs, it makes it a high probability for the price to reverse. And because of that, let's go on to the analysis. So as you can see on this point, we have this chart. So this level, we'll call this level let me just write something. I'll write it on this side. I think it's here. So this level, it's called higher premium. Extreme, I'll call it extreme premium. Extreme premium. Then you can mark also another range. Forex is as easy as this. Let's keep this color green. Then we label here premium. Keep it there. So these are the regions. So extreme premium, that means if price gets deeper to this, and as you can see in the mid threshold, if a candle doesn't close, they say body tells the story, the weak destroy. The weak manipulates or destroy. The weak is just to destroy, but what tells the story is the body. The body should close at this mid threshold. I call mid threshold because if the price goes deeper to this and closes above, this means price can go above it as a close. But just if it's just a week, it's just getting some liquidity off, but it's not meant to, it will like reverse, it's just a counter reverse than a continuation. As you can see here, a deep premium. So as you are selling something, so this is known as a deep premium because price normally after this area they drop rapidly because it's like reaching an agreement. So the premium, and this side, let me just mark this side, then we can talk about it. Let me get it color red. So this is a discount. Then you have another one, we keep it at this point also. I give it the same color. I think I should keep the same color. Well, let me look for the other color. Let's say purple. But purple is similar to the other one, so let me look for the same color. Let me just write it extreme discount. So guys, these are the levels. So in extreme premium, so this is like a price on the market to agree at a point. Let's say it's a good, let's say a good, they say, so this is the middle point of all this. This is the most important. That's why price normally accumulate at this area. We call consolidate at this area because they're deciding on what price should be settled on. So as you can see here, this area price has accumulated at this region. As you can see, this is like a support. I'll say a support, but it's not a support until we find some more reasons on why is it called a support. So as you can see, if the price, they are not negotiating, so the price, this one is saying that the price goes higher. Let's say this is $100, $75. Let's keep it in prices: $100, $75, $50, $25, and 0. So for the buyers to buy, the price should be taken down to a lower discount. So if it's at 25%, if it's $25, more will buy. If it's 50%, $50, it's like half of the price, people will buy. But if it's $25, people will say, no, this is the point that I need to buy, then sell it at a higher price. So the lower it goes, the deeper. And that's why I say extreme discount. So you have been given an extreme discount. So the price is bought at an extreme discount. There are more volatility in the extreme for the buy, and also there are more volatility. Let's say there are more selling at the extreme premium. And if they bought at this area and they say if it reaches 75, I'm going to sell. That is what the market is running to. So this is the extreme discount, this, and this is the discount area, the premium, the extreme premium. So what I wanted you to learn from this is that the price normally it follows this area. So these areas, I'll call them the grade levels, so the DRT levels. So price normally reacts to these levels. And one of the reasons is that the premium and the extreme premium give the best sales, especially the extreme premium. there are more volatility for sale, there are more people who are willing to sell at extreme premium, and there are more people who are willingly and will accept mostly at the to buy at the extreme discount. So let me just remove this and we continue the arrays. They is called PD arrays. So just remove this. Other thing you have to learn is that let me keep it. PD arrays. So PD arrays, it means the P. Let me remove this so you can see the P. It's a premium arrays, and the discount arrays. So the premium and the discount arrays, as you can see, premium and discount arrays. First, what is the word arrays? So let me just keep it here. Arrays. Examples. Examples of arrays. We'll say order blocks. Order blocks, fair value gap, breakout, so I won't go to more details on this, but I'll just tackle the amount. I think at least some of there, and you can see also void, liquidity void, So before I go to the PDRs or the PDRs, I want you to get the most important thing that it's mostly important. It's like, let me just keep it another tab. The most important thing you have to learn about Forex is the liquidity. So liquidity is where price goes, like it's where it's attracted to the liquidity. Let me just keep the, so liquidity in short form will keep let me keep something to show the liquidity. Liquidity. I have something to give a clarity on. So liquidity, it's like a magnet. It's like a magnet. It's where the price is attracted to. And liquidity, it's mainly like if you place a buy, let's say at this area you place a buy, and the market makers, like the market makers are not like us, the huge funds, they're not like us. They enter where there's liquidity. They don't just place some orders because they have more orders to place, a lot of orders. So as let's say it's a market, let's say a random market, local market in our area. So for a person to buy tomatoes, they have to be sellers. If someone comes with 10 tomatoes, wants to sell, so he will go, and if I want to sell, if I'm the seller of the tomatoes, I have 10 tomatoes, and person comes with money to buy just 2 tomatoes, I'll be able to sell for them. But if a person, like a rich person, comes to me and say I need 1,000 tomatoes and I only have 10 tomatoes, so he wouldn't buy and he'll just look for more places, he'll wait for more people. Let's say I say I'm the one opening the market, let's say early enough, so I'll say let's wait for other people. Then we open like more people who are selling tomatoes so that we can give the 1,000 tomatoes, and that's how they get the market. So if like it's like for they need a lot of sellers for them to buy, and they need a lot of buyers for them to sell. So if maybe we have the people are early, maybe it was at 8, they didn't open the shop, he waits until they open, then he get access to the sellers. Like we join together and sell the 1,000 tomatoes. So that's how they normally operate, the market makers. That's why you have sessions, the Asian sessions, the New York session, the London sessions. So those are the times where majority of trades enter the market, because they are buying against, they can't, like it's like volatility is entering the market for them to sell. So if they sell at this point, they're the ones, let me mark. So at this point, it was a sale. So they didn't just place a sale, they waited for more people to buy their orders. Retailers, especially the retailers, they want them to buy their orders so that they can sell. But they can also drive the market without your orders, but they need a lot of, like, they need people to trade against them. That's why they say the financial market, the forex market, says 90% of the traders lose money for the 10% to make the money. So 90%, including me and you, we lose money for them. Not that they don't also lose money. Sometimes they also lose the many firms, like big huge firms. The huge funds, they also lose some money. Let's say it's Tanzania, Kenya, Uganda. Uganda placed a buy, so Tanzania buy, and let's say Uganda placed a sell or Kenya placed a sell. So the majority will win. They will drive the market, and the less people, like the one Kenyan sell and also the other individual people who would be against the market, will get a loss. And also sometimes before the session, London session, Asia session, and the New York session, the other times price is driven algorithm with some AI. I think it's AI what's driving the price before the market makers or the huge funds enter the market. So this is the reason why I say liquidity is more important in the market. For them to buy, they need a seller. That's why you lose money and they make money. That's why they're still in the market and they'll still be in the market. The biggest firms, I'll say, which brings a lot of market, I'll say the BlackRock. It's not in the forex industry only, but they like generate economy. Like if they buy gold at high price, because their net cap is like trillions. I'll say Citi, it's a big firm. Citi, the New York Exchange, New York Stock Exchange. We also have a Nairobi Stock Exchange. But this stock exchange, let me just keep exchange. So you have larger people who are willingly to put billions of dollars, billions of shares just to drive the market. So we also have the biggest thing that is affecting market. So before we get to the EURUSD, I just want to give you the psychology part. That's why I want to give you the advice of what markets is. We also have the factors affecting market. Let's say gold, silver, oil. Gold and silver, they're known as God's money. That's what I learned. It's like God's money. They never disappear and they have value. The more time goes, the more value they get. So gold and silver, they move together, each other. And gold, silver, and oil, they move against. They move against dollar index. Let's say just dollar. So this and this, they move against. If this rises, this falls. If this falls, this rises. I'll talk more in details on this. Let's just continue the program my mentor. So this, I'll talk about it later. But now let's go with the PDRAs. So the PDRAs, we have the order blocks, fair value gap, breaker, and liquidity void. And we mainly talk about liquidity. So as here we have seen, before we mark the zones high and low, it must have swept the buy side liquidity. So this is the buy side liquidity, and this is the sell side liquidity that has been swept. So this is the high and this is the low. We mark to 4 regions with the February retracement: 0, 25%, 50%, 75%, 100%. We get 4 boxes. So here we say it's extreme premium, discount, extreme discount, right? So in between these areas, these levels, we call them I'll call them the grade levels. We need to identify what makes them resistance or support. As we start on this area, let's just mark this area. Let's start with this area. We analyze this area. Let me just close it for clear chart. So this area, as you can see, we had price at this point that it swept the liquidity, and also before we get this area, as we can see on this area, we had normally call this like a breaker or order block, a resistance. This was a level resistance, as we can mark from this area. So we'll just keep this. This is where price resists. So mark this region. Price went at this region, then it drops. First it had swept this liquidity and this liquidity, then it reaches at this premium level, and also PDRA's order block, this order block, then it drops. So after it drops, as you can see, it drops, leaving. So I'll say if there is chart, let's say at this area. So I'll talk about order blocks. The order blocks, the different order blocks. I'll make this the less important, like the shortest video, but I'll talk in another video. So this is the order block that resisted the price from getting through, and it closed. This is what I wanted to say. It closed below the mid threshold, below the middle of the order block. We say if it's a wick that has closed above, if it's a wick that passed through, it doesn't care. But if it's below, like the body tells the story, the wicks destroy liquidity. It's just searching for liquidity. It just swept the liquidity, but it closed below. So keep it at a resistance. As we can see at this point, we also have order block. So order block is the down. So for this one, we'll call it a bullish order block. So there's bullish order block and bearish order block. Bullish order block, they make the price goes up, and the bearish order block make the price goes down, like drops. So as you can see at this area, this was a bearish order block, and this will be a bearish order block also. So the last down candle, the last up candle, I'll say the last up candle. So as we close at this point, the last up candle, this is the last. Let me just remove this. As you can see, this is the larger one. So this is the last up candle. We can mark from the week, but also you can mark for the stop loss, you keep it at the week. But for the marking the body also, it subs a lot of for the body it's like better one, but for the stop loss keep it above, because for the liquidity sweep also. So this area, this is the order block, the last up candle, that price gets into it and closes below the mid threshold, then drops. So this is one of the PDRs that it occurs at the upper premium, that is extreme premium areas. So this affected the market. Why? This was a bearish order block, that it was at a premium level that we anticipated price to drop, and second, there was a bearish order block that will make the price drops. And also before that, there is a fair value gap. Fair value gap, it's a price, it's like three consecutive candles, or a gap between candles, especially 3 consecutive candles. So you have 3 candles. Let's say we can't draw, I don't think if I can draw. Let me just say, so this 1 2 3 with a fair value gap, 1 2 3, we also have a fair value gap. I can also mark it as this. So first indication was that our price will drop at this area. So this area for the premium discount, extreme premium discount, we had the resistant area also for the breaker, bearish order block at this area. Then we also had a bearish order block at this area. Then price drops. As it drops, for the fair value gap, as you can see, it drops, it gets and drops, then gets back again for this area. So I'll close this. I want the chart to be as clean as possible. So we also have the last up candle, that is this one. This one also acts as an order block, and the price gets again to the order block and drops. And if it drops also if this is mitigated, so normally we look for the one that has not yet been mitigated. So this has already mitigated, so on the future price we look for this to be mitigated. It drops as the price drops, so we look in future the price mitigated at this area. So at this area, I think you are done on the upper side. Let's look at the downsides. This is the extreme point. These are the PDRs that were in the extreme region. As you can see also, it shapes the liquidity, like it's about liquidity. So this is the fair value gap, and also liquidity is above. So liquidity, if you place a stop loss here, you become a liquidity. Like your stop loss is here, you are expecting it to drop, then price goes up again, so you are swept as a liquidity. Then oh, I couldn't know that talking would bring me like thirsty. A minute, I'm coming. So I'm back. So I just wanted to tell you about so this is the what the PDR is on the extreme premium. So you're down to this area. So at this area, what you can see, if price gets at this area, it drops as here, as you can see at this area. Then we have this area. Let's mark it. So this is the most important thing, the mid threshold. So normally I like to mark it a different color like red one, because it's one thing that price cannot. This sometimes it cannot respect this area, but this area is mostly respected. As you can see, let's just start marking this area like this. So price has been accumulated in this area. So for the buy and for the sale. So at this area, what can you see at this area? Price is resisting. So it gets down, then upward to. So at this area, it's like if you're targeting like you have taken a sale at this area because of the order block on this area, the bearish order block. So don't aim for the low first. Normally the ICT tells you aim for half the range, the midpoint, half the range. So as you can see here, from here to here, let's say we mark from here to here, aim at this area, because also this order block, as you can see on this order block, price comes, and also on this other block we can say it's highly to be passed, because also there's a liquidity on this side. So every like down candle week, it's liquidity above. So people who bought at this area, they put their stop loss at this area, making it a liquidity, most of the people. And if there are more people, it will go and they'll be liquidated. So this is the area. If your analysis to your first TP must be at this area, this area is likely to be taken off than this area. And if you are sure enough, you can also take at this area. But remember, there's also one big candle like this one is also another block. Let me just remove this and say, so this is also another block, these consecutive candles. So they are other blocks, which makes the price like here, the price has drops to this order block, then the very bullish order block, then the price went up. This was mitigated, so it won't be a support next time. The support has been broken. So the support has been broken because it has already been mitigated, but it helped. At some point there was a buy, person took a buy side and this side, and as I tell you, the most important thing is that don't aim for the liquidity, whole liquidity, aim for halfway. As you can see at this area, the TP was this one, then targeting this. So if you took entry at this point, aim at this point, 50% range or 25. Let's say I just keep it the wrong way, but let's say it's this way. range, the 50% range. Why? There's also a liquidity here swept, and there's also a breaker. So you normally call a breaker. So price runs through, then this one is also resistance most of the time. So because of the breaker, aim for 50% range kindly. It's at the right time of the breaker. As you can see, price was supposed to reverse at this point, but it went up. But this one was the resistance point also. So price has come at this point, then it has resist going up. So if in some cases also there's also a fair value gap at this area. So there's also a fair value gap at this area. Imbalance, we say a fair value gap is a gap between 2-3 candles. so the wicks have not catch each other. So here there is no fair value gap, here there is. And the best thing about fair value gap is that price will come back to the area. That is the best part about fair value gap. Price will come back to that area. So as you can see, we had a price came back to fill the liquidity to just sweep the at least the liquidity, then goes up to the main intended order block. So this is, you can see it as a small range, but it's a monthly candle. So at this area, it's a huge movement. So people can hold their trade from this point to that point, and people can hold that point to that point to that point and get millions of money. So if you do like monthly, weekly, daily, you go down, it's a huge amount. So it was a monthly, like from this candle to that, it was a monthly. From this candle to that, 2 months of buy, 2 months of sale, 3 months of sale, 2 months of buy, then some consecutive months of sale. So this is the most important. So at this region also, we want price to drop at this region. As you can see at this region, so this is where we are looking for sale at this area. So if you are at a premium level at this area, two areas, you are looking for a sale, not a buy. As here we look for a sale, it drops. At this point also, there's a fair value gap at this point. Or here we have a fair value gap. So price, this is a continuation gap. As you can see, there's a fair value gap. Price enters to the fair value gap, then drops. It also enters to this area, then drops. And also this area, it was also mitigated and drops. So this is for the sell, and this is for the buy. So on this other for the buy, as you can see, price moved at this area, which was the order block, then it spikes out. So if you have maybe a small account, I would prefer, if you are on the order block like in this area, but this is so risky, so just look for the mid. So this from here to here. So for this range, you want maybe to get 1:3, 1:4. If you keep it this way, let's say your stop loss is at this area, then TP on this area, as you can see, you failed, right? So but if you go deeper, you'll realize price mostly just sweep this liquidity. So you can put your order at this area. Sometimes it can be mitigated, sometimes cannot. As you can see, 1:2 already, and we keep it, maybe the target we are targeting at this area will get 1:3, halfway, 1:3. And also there's also this other block that also helped. So 1:3, as you keep it as halfway. So that's one lesson you remind of me that, but you may get a consecutive missed trade because of that, but if that is your part of the rule, getting 1:3, stick to it. If you lose one, it's okay. You lose one, it's okay. But if you get 1:3, it's like up 3 times what you risked. So at this point also, we can see the 50% range also resists price going downwards, and also at this point the 25% resists price from going upward. At this area, why is it going upward? Because first is it has swept a liquidity at this area. We normally keep this as a X, let's say X is a liquidity. Keep it at the center. X, a liquidity swept. And also there's a fair value gap in between here. In between there's a fair value gap. And also price moved at this point, like at this point. and also this was a fair value gap, and also there's this, the last down candle is a bearish order block that is at this region. So for the fair value gap and order block, it creates a high probability buy. So it buys at this point. So this we just don't get in a fair value gap. So at this area, like you get in this, you just don't get in because it's a PDRs. We just say no. There's a confirmation. The confirmation, I'll make it easier. It's like a confirmation that a price has sweep. Normally we have this region like let me show you this. If price gets into a premium discount, let's say at this area, then it goes up, then gets again, then goes, then it closed above this area, there will be a fair value gap in between this area. But remember, this is also a breaker, so if there is a fair value gap above the breaker, it will be easier. If there is a fair value gap here, price plus the press the order block, the breaker and the fair value gap will bring more price to go upwards. But if there is here down below here, don't be like, the price cannot reach at this area because of this breaker. It will resist price from reaching at that area. That is one thing I will talk about later, but this time I just wanted to know about the monthly. So this is the price on the monthly. As you can move for the weekly, we'll see what was happening on the weekly chart. So this is what I wanted to say. So this is what I want to say for the confirmation. If we reach at the premium side or the PDRAs, this and the fair value gap in between. So for the fair value gap for the confirmation was at this point, and price moved to the fair value gap, not at below the fair value gap. If the fair value gap aligns with the other block, because this can be the other block, gets in the fair value gap, risking higher. So on the fair value gap, I won't tell you to, let's say, go halfway midpoint. No, for the other block, yes, but for the fair value gap, go at that point. You can also keep your stop loss at this area, then you target maybe the zone maybe above 1:2. 1:2 better than 1:1. At least it's swept. You can also target higher. Maybe the price in long term can go higher than that. As you can see, this is the entry. This is what I wanted to tell you about for the monthly. So these are the monthly and weekly, and I think for the monthly and weekly, yeah, monthly, weekly, as we see on the daily, it was a long move. Couldn't imagine. As you can see, it was a long jump for that. Yeah, as you go, you can keep the stop loss going. As it reaches another breaker, you keep the stop loss going. Like at this area, it cannot go down below because this area will resist price. So you're keeping dragging the stop loss upward. So this is the premium and the discount levels, and thank you for that.